Every major financial cycle has a moment, a quiet, almost invisible turning point, where the future diverges, a single point on the timeline that people only recognize after the wave has already accelerated. And what's wild is that this moment isn't coming later. It already happened. Not with a headline, not with an emergency press conference, not with the dramatic language markets usually expect. It happened quietly, technically, almost politely, and the majority of investors completely missed it. This is the story of the Federal Reserve's silent pivot, the shift that resets the structure of liquidity, the one that sets up everything that will unfold in 2026 and beyond. A shift that will not just influence markets, but rewrite the entire direction of capital. Because the truth is simple. The Fed didn't signal the next era. They triggered it. And today, I'm going to show you what changed, why it matters, why 2026 will be the year everyone finally wakes up, and how this invisible pivot will reorder asset prices, risk premiums, and the wealth distribution for an entire generation. This is the part most people never see. This is the hidden mechanism beneath the noise. Let's begin. Section 1. The moment that looked like nothing, but changed everything. It began with a statement so subtle that 99% of people didn't even register it. A quiet remark, a procedural sounding update, a technical adjustment. The Fed announced that balance sheet runoff, QT, would end ahead of schedule. No alarm, no shock, no theatrical tone, just a timestamp. But inside that timestamp was the signal. The same signal that appeared in 2012, in 2016, in 2019, each time right before the liquidity cycle flipped. Because the end of QT is not the end of tightening. It is the mechanical boundary of tightening. It's the moment the system says, you can't drain liquidity any further. If you push more, the plumbing breaks. And every time the plumbing is at risk, the Fed does the same thing. They stop shrinking the balance sheet. They stabilize. Then the expansion begins again. Quietly, gradually, inevitably. What happened wasn't symbolic. It was structural. Section 2. Why this moment is different. The U.S. debt system has evolved into something unlike previous cycles. Treasury issuance is at levels no foreign buyers can absorb. Domestic markets are saturated. Money markets need higher reserve balances than ever before. Banks are more dependent on secured funding. Government liabilities expand faster than the private sector can digest. Put simply, the system cannot function without a growing level of reserves. And once the Fed hits the minimum safe level, QT must end. Not because the Fed wants to pivot, but because the system demands it. This is the part most people misunderstand. Tightening is optional. Liquidity provision is not. You can run a monetary system with too much liquidity. You cannot run it with too little. 2026 will be the year the world realizes this. Because what we just entered is not a pause, not a wait-and-see period, not a neutral stance. It is the beginning of structural balance sheet expansion, the same pattern that preceded the 2013-2015 bull wave, the 2017-2018 tech melt-up, the 2019-2021 hyper-expansion era. But with one difference. This time, the scale is larger, much larger. Section 3. The quiet signals inside the system. To understand why this pivot is so powerful, we have to look at the system beneath the headlines, the core funding rails. Because the earliest signals of a liquidity turn don't show up in CPI reports. They don't appear in unemployment data. They don't come from GDP. They appear here. Overnight lending markets, collateral demand balance sheet capacity, repo spreads, facility usage, interbank stress indicators. And over the past months, those indicators all flashed the same message. Reserves were approaching the danger zone. That's why short-term rates pressed above target, funding spreads widened, banks tapped emergency facilities more often, and repo operations quietly increased. None of this is random. All of it is structural. Once the system sends these signals, the Fed doesn't wait for recession. They don't wait for political pressure. They don't wait for inflation to hit a magic number. They move when the plumbing demands it, and they already moved. The shift already happened. Section 4. What happens next? The three-stage liquidity cycle. Every major liquidity reversal follows the same three-stage sequence. Stage 1. Friction hits the limit. This is where QT ends, not because the Fed chooses to stop, but because the system can't tolerate further contraction. This just happened. Stage 2. Stabilization. Balance sheet flattens. Reserves hold. Emergency funding usage normalizes. Repo spreads calm. Liquidity stops deteriorating. We are here now. Stage 3. Gradual expansion. This is the part that arrives quietly. Reinvestments increase, bill purchases resume, reserves begin to climb, and the balance sheet starts expanding quarter by quarter. This phase is the most important because it triggers the asset repricing wave. And that wave always begins before anyone sees it. just like 2019, just like 2012, just like 2016. By the time the average investor realizes what's happening, the early stage upside is already gone. 2026 will be the year when the world finally notices. But by then, the asymmetry will have already played out. Section 5. How markets respond during these phases. This is where things get interesting. Liquidity doesn't lift everything equally. It lifts assets in order, and the hierarchy is predictable. First, scarcity assets. These include Bitcoin, gold, commodities, any asset with limited supply. They move early because liquidity expansion lowers the value of cash relative to fixed supply. Second, high growth technology. When discount rates fall and reserves rise, growth assets explode upward. This is exactly what happened in 2013, 2017, 2020, late 2023. Tech becomes the primary beneficiary. Third, broad equities. Indexes rise, volatility compresses, and capital rotates from defensive sectors into risk-on segments. Last, the real economy indicators. This is when the headlines finally turn positive, and this is always when retail investors enter. But by this point, the asymmetric phase, the early exponential part, is already complete. Here's the uncomfortable truth. The biggest gains always happen in the part of the cycle where people feel the least confident. Right now. Section 6, the 2026 repricing window. Why 2026? Why is this year so structurally pivotal? Because several forces converge simultaneously. 1. Political cycle pressure. Monetary tightening is never sustained during volatile political periods. No administration wants slow growth. No Congress wants collapsing markets. No politicians want recession headlines. 2026 to 2027 will be a window of extreme policy accommodation. 2. Debt rollover math. The U.S. must refinance trillions of dollars at higher interest rates. This can only occur smoothly with rising reserves, balance sheet expansion, and stable liquidity. 3. Global demand shift. Foreign governments have reduced U.S. Treasury purchases. Domestic absorption requires higher liquidity levels. 4. Structural limit. The system has reached the point where reserve scarcity is no longer viable. In engineering terms, we hit the minimum liquidity design threshold. 2026 is when this becomes undeniable, and once it becomes undeniable, the floodgate opens, not dramatically, not in a crisis, but structurally, relentlessly, mathematically. Section 7. Why most people will miss this again. Because humans don't allocate based on data. They allocate based on comfort. And the early phase of every expansion cycle feels uncomfortable. Headlines are negative, sentiment is bearish, uncertainty is high, the economy looks weak, the previous cycle's scars are fresh, but markets don't rise because everything looks good. Markets rise because liquidity moves first, and liquidity already turned. People will ignore the signals. They will wait for confirmation. They will wait for headlines to sound positive. But headlines only turn positive after asset prices have risen for months. That's why the average investor earns average returns, not because they lack intelligence, but because they misinterpret discomfort as danger, when in reality, discomfort is the signal. Section 8. What asymmetry looks like in this cycle. Let's talk opportunity, not hype, not speculation, not moonshots, structure, mechanics, math. Here's how liquidity expansion historically reshapes asset performance. Bitcoin and digital scarcity assets. Move first, move fast, move violently. They respond to liquidity with reflexive demand. Technology and AI equities. Growth assets with long duration cash flows benefit from declining discount rates. 2026, 2027 could replicate the dynamic of 2013 cloud expansion, 2017 software cycle, 2018-20, 2021, AI acceleration 2024, 2025, chip cycle, gold and commodity structures. These move in the mid-cycle phase as monetary expansion becomes visible to institutions. Broader equity markets follow last. By then, the early asymmetry, the part with the highest returns, was already captured. If someone waits until 2026 to feel confident, they're entering when upside is compressed, not expanded. Section 9. The only real risk, expanded. Every financial cycle has a wild card, and it's almost never what people obsess over. Not GDP, not CPI, not unemployment, not interest rates. Those are surface waves on a much deeper ocean. The real wild card, the one force that can bend the timeline of liquidity, isn't economic at all. It's political. Political structures are the one domain capable of disrupting sequence, slowing mechanisms, and creating temporary turbulence. Not permanent derailments, but turbulence. Because when you zoom out, every liquidity cycle is built on structural math. And math doesn't negotiate. Math doesn't debate. Math doesn't care about headlines or elections. But politics? Politics can distort the pathway temporarily. Here are the 5 political forces that can bend, delay, or scramble the timeline. 1. Government gridlock. When legislative bodies freeze, nothing gets done. Budgets stall, spending authorization slows, and capital markets operate in a fog of uncertainty. Gridlock doesn't stop liquidity, but it can delay implementation or mute momentum. 2. Fiscal standoffs. Debt ceiling battles, funding deadlines, shutdown threats. These moments create artificial panic, even though the outcomes are historically predictable. They temporarily shift market psychology while the underlying liquidity direction remains unchanged. 3. Policy disputes. Conflicts between Treasury, Congress, and the Fed can create mixed signals. One branch tightening, another expanding, a third contradicting both. This doesn't stop liquidity, it simply introduces friction. 4. Regulatory uncertainty. New rules, new proposals, new oversight frameworks. Markets hate ambiguity, not regulation. Ambiguity slows flows, but regulation never stops a structural cycle. It just reroutes capital around obstacles the way water flows around rocks. 5. Domestic political instability. Elections, investigations, challenges, leadership changes, these create noise and optical chaos. But they don't alter the mathematical requirement of liquidity expansion in a debt-based system. Here's what's important. Political conflict can distort the calendar, but it cannot change the destination. It might delay liquidity expansion by a quarter. It might mute the early acceleration phase. It might even create sharp, temporary volatility. But the core of the system doesn't care. Banks still need reserves. Debt still needs refinancing. Markets still require stable funding. Issuance still needs buyers. The machine still demands lubrication. The system isn't democratic. It isn't ideological. It isn't partisan. It is mathematical, and mathematics always wins. Every time political turbulence tries to fight a liquidity cycle, the cycle absorbs it, and then proceeds exactly where the math says it must go. Expansion is not optional. It's structural. It's inherent. It's inevitable. Section 10, the question. Most people avoid expanded. And that brings us to the question almost no one wants to confront. If the pivot has already occurred, if the balance sheet is finished contracting, if the road to expansion is not speculative but mathematically baked in, and if early asymmetry appears before the crowd recognizes it, then what exactly is gained by waiting? Waiting feels safe. Waiting feels responsible. Waiting feels rational. But what does it actually produce? Does waiting reduce risk? No. It increases risk by removing the advantage of early entry. Does waiting create better timing? No. Timing doesn't improve when prices are higher. Does waiting give clarity? No. Clarity is a lagging indicator. Clarity only shows up after markets have already repriced. Does waiting eliminate volatility? No. It just ensures you experience volatility at worse valuations. Waiting doesn't protect you. Waiting only guarantees that you enter once the asymmetric opportunity has evaporated. And this is the tragedy of every liquidity cycle. People demand certainty in a world where certainty always arrives last. Liquidity moves first. Prices follow liquidity. Sentiment follows prices. Headlines follow sentiment. By the time a person feels safe, the market has already priced the majority of the upside. That's why late entrants always believe the system is unfair. Not because it is, but because they entered after the cycle already delivered its largest gains. The pivot doesn't happen when it feels good. It happens when it's uncomfortable. And right now, the discomfort is exactly the signal. Conclusion. The next era begins now. Expanded. Years from now, people will look back at this moment, this quiet shift, this subtle inflection point, and the story they tell will sound identical to every other cycle. It was obvious. The signals were right there. The Fed couldn't keep tightening forever. I knew liquidity was coming back. But that's hindsight talking. Hindsight is the illusion that clarity existed all along. The truth is much simpler. Most people don't react to signals. They react to comfort. And comfort is the enemy of opportunity. Comfort appears when the cycle is already mature. Comfort appears when valuations are already elevated. Comfort appears once the headlines finally turn positive, when the early exponential part of the cycle is gone. That's why comfort is expensive. So the real question isn't, when will the Fed expand again? Because the expansion phase has already started, subtly, quietly, structurally. The real question is, will you position inside the wave or watch it pass again from the shoreline? Because 2026 won't mark the beginning of a new chapter. It will mark the moment the crowd realizes the chapter began long ago. The investors who understand this, the ones who recognize the pivot before the headlines confirm it, will experience the next decade through a completely different lens. Not because they predicted the future, but because they understood the structure, because they saw the shift, because they acted before comfort arrived, because they positioned when uncertainty was highest, which is precisely when asymmetry is greatest. The next era isn't coming. It already began. And the only question that matters now is, are you inside the wave or outside watching it build?